And I think they will peg the back end of the Treasury market to gold. And I do think it will be at a much higher price. In fact, Luke even talks about letting the price get to 7,000 or 8,000 organically and then revaluing it to a much higher level. Now, it's important to remember, as we've mentioned on your show before, Jared, that gold is held on the balance sheet of the U.S. government in what's called the revaluation account. That's the name of it. Of course, you can't make that up. And every $4,000 increase in the price of gold would result in $1 trillion given to the Treasury General Account. I'll explain how the whole mechanism works. It's as simple as a Treasury Secretary saying to the head of the Federal Reserve, Jerome, hey, Jerome, put the price of gold at $24,000 an ounce. Now, who would that benefit? Well, it would benefit all of the central banks of the world. It would arguably benefit the United States government. I would argue they're probably behind the massive importing of gold that we've seen since November. North of 100 billion that we know of since November. And there's probably a whole lot more that they're buying through proxy banks around the world, in Switzerland and in London, in Singapore, wherever they're doing it, or even through local and artisanal miners, as we find now that the central banks have admitted to doing recently, to disintermediate the marketplace. Same thing China's been doing. But anyways, the idea is you bring back all of that gold. Now, when you realize that we've weaponized the dollar and that we are inflating it away at a reckless abandon, people say, well, what do you mean by that? How do you know we're inflating? Well, first of all, the CPI is a lie. It should be called the CP lie because they massage the numbers to make us believe inflation is under control. John Williams of Shadow Stats, who just uses the way the numbers used to be measured, previous administrations would say you add an 8 to that, and it's about 11% inflation, if not higher. But the point is simply this. We weaponize the dollar. We have irresponsible fiscal policy and brain-dead monetary policy. They just came out with their estimate for the third quarter in terms of the amount of debt they'll need to issue. $1 trillion is the number in 90 days. They're going to need $1 trillion. That's at least $3 trillion a year in deficit spending for the next 3 years. When you realize that in 3 years, 2028, we need $28 trillion just to pay for the bonds that come due that we've already issued. Add the $9 trillion in deficit spending minimum, you're at $37 trillion. In the next 3 years, we'll take in $15 trillion in tax revenue. So we're just over 1/3 of the way there. How do you continue to do that? Well, you print, you inflate, which is what they have to do because there's no demand for our treasuries on the back end. In fact, all these countries are selling, right? And so we're supposed to believe that the United Kingdom is now number 2, surpassing China. It's two broke guys leaning against each other to not fall over. You know, the UK is one of the most indebted nations in the world, only second or third to the United States. So one debt country buying the debt of another broke country. And so here's what I think they're going to do. I think they will let gold rise organically, and at some point they will revalue it to a level high enough. And the reason I say 24,000, and that's the number Jim Rickards comes up with, and he has a metric of dividing M2 or whatnot into the price of gold, and he gets 24,000. So if the Treasury Secretary did say to Jerome Powell, let's say gold's at 7,000 or 8,000 a year from now, and he says, go ahead, push it up to 24, it would work. Or whoever the Federal Reserve Chair is at that point, it would work without congressional approval. You just simply go do it like this. Hey, head of the Fed, put gold at 24,000. Who does that benefit? Well, it benefits the U.S. for sure, but it would also benefit all of the central banks who have been buying gold hand over fist. So you're not going to get a ton of pushback there. But when you look at the mechanism of doing that, in essence, what you would be doing is wickedly devaluing the dollar, which is something they're going to want to do. You already see the dollar down 11%, and Trump has come out and said, in fact, let me just see if I can find the actual statement that he just came out and said. Where is this darn thing? He said something that I thought was, here it is, I think this is it. Bear with me. I just thought, he says, Trump said he liked a strong dollar, but you make a hell of a lot more money with a weaker one. So when you have a strong dollar, one thing happens. It sounds good, but you don't have any tourism. You can't sell tractors. You can't sell trucks. You can't sell anything. Manufacturers would be the first to benefit from a falling dollar. Japan and China fought for weaker currencies for decades and were able to dominate markets over the years. Now, it doesn't sound good, but you make a hell of a lot more money with a weaker dollar. So if they bring all this gold back, like we've seen, huge amounts, 100 billion that we know of. They devalue the dollar by revaluing gold. So the dollar goes way down. In other words, I think they're going to sacrifice the dollar, Jared. They're going to inflate it away to save the system. So you have the stable coins pegged to the short end of the market, which keeps the engine going. You put zero coupon on the long end, zero bond rate, zero, and peg it to gold. So deliverable in gold at maturity, so that the more reckless our monetary policy is and irresponsible our fiscal policy is, will only increase the value of gold at maturity. So you can have a zero coupon bond on the back end. You make it redeemable in gold. You revalue the price of gold way higher, which devalues the dollar. Now you are in the perfect position to do what? Bring back your manufacturing at a low value of the dollar and low borrowing costs. In fact, zero borrowing costs on the long end. You bring back your manufacturing. You say to the world, this is what we need to do. You say to the U.S., we need to do this in order to give our children and grandchildren a future. We're bringing back our manufacturing at zero borrowing costs and a weak dollar, which stimulates the exports to begin with, but allows us to reshore, build the manufacturing capacity, train the workers, do all of these things so that we actually have a chance to grow our way out of this problem. When you have the indebtedness issue that we do, there's only one way to pay for it, and that's print or default or growth. And the growth is out of the question until we bring that stuff back. But unless you have a weak dollar and low borrowing costs, you can't do it. Furthermore, how do you pay $28 trillion in long-term debt obligations that are due in 3 years if you only take in $15 trillion in revenue? So it's an issue where I think the stable coins will keep the game going, and then they peg gold to the long end with a zero interest rate coupon in order to bring back manufacturing to grow our way out. So yes, I do think they will revalue gold. I truly, truly do. 100%.
Without 100%.
That, and how do you do it? How do you do it with inflation on the rise?
Yep.
Without raising interest rates, it blows up the system. You peg the back end to gold with zero coupon. Issue stable coins for the front end to keep the engine going, and that synthetic demand replaces the organic demand that we once had when we had trade surpluses and weren't involved in wars all around the world and produced things and were revered. A lot of these things are no longer part of the issue, or part of the ecosystem. Well, I mean, I just think that it's the government really wants the stable coins for sure, because it's going to give juice to the Treasury market. You'll see banks starting to issue them. You'll see private institutions like American Express. They'll all start issuing stable coins, which will have to be backed. That's the legislative part, by Treasuries and monitored. And so, the banks, I suppose, will kind of be happy. They'll just get all the deposits that go in and issue the stable coins, and then they'll buy Treasuries off of it. And at this point, I think it's going to supercharge. You have to do it in order to keep the demand for Treasuries going when the rest of the world that has traditionally financed our debt is moving the other direction. So I think it'll happen faster than people think. And it will be a trend that doesn't go away very soon, to be honest with you. And it's interesting when you talk about potential pitfalls of something like this legislation. I've talked a lot about the M-bridge, or the bridge technology that central banks are using cross-border in the BRICS network. And I mentioned on your show, I believe, a couple weeks ago, that it is my belief, once Lavrov, the Russian finance minister, said that they're going to open it up to non-BRICS nations, the first thing that I said on a podcast was they're going to open up to the Belt Road, which is 75% of human population, 50% of global GDP. They're not in the BRICS, but they're very closely aligned with the BRICS, especially in the way they're producing commodities and trying to industrialize these under-industrialized countries and bring their resources into the mix. Well, I watched an interview last night. Let me give you the guy's name. I think everyone should check it out. Andre Mikhailshin. Anyways, what Andre said is he's the CEO and he is the founder of BricsPay. Now, BricsPay is the B2B side of the bridge network. It's the B2B, business to business, small bank to small bank, consumer to business, or bank or business to consumer. It's like Visa, basically. And he said a lot of interesting things. We're not trying to antagonize the West. We're not trying to create a revolution, just an alternative. And we'd love to work with companies like Visa and American Express, but we can't because of the sanctions, on and on and on. But he said some really interesting shit. The first thing he said to me, or not to me, he said, I was listening, was that right now they have delegates meeting in China right now trying to, with the idea of to introduce this BricsPay technology through the Belt Road. So you have the, and that was ding, 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 ding. So you have the bridge, M Bridge, which is now BRICS Bridge, which will be, using the central bank to central bank in the 150 plus countries in the Belt Road, plus the countries they already signed up in what are they called? The countries in Southeast Asia, what are they called? I forgot even what the damn name is that they're called. It's Asian countries. There's 11 of them in Southeast Asia and 5 of the Middle Eastern countries that represent 38% of global GDP. They've already signed up to it. Now they're going to open it up to other countries, which is what they're talking about is the Belt Road and the Shanghai Cooperation Organization and the Eurasian Economic Union. On top of these Asian countries, you're talking 90% of human population. That's going to be the central bank to central bank. This is the B2B and the person and the individual to the bank and to the business. And they said they're going to open it up to non-BRICS nations. So immediately, you're talking Belt Road and all these groups. All right. So the lady says, well, there's terrorist organizations out there, Andre. What are you going to do to safeguard that? And he says, well, because we're opening up to all of these nations, we're very cognizant of KYC, AML, and KYT. Now, what the hell did he just say? I rewound it because KYC I know, AML I know. I don't know many people who know what KYT is. Do you happen to know what KYT is? If you're watching last night, you must. We have continuing classes on KYC and AML. I didn't know what the hell KYT is. It's know your transaction. So this type of technology has in it, and I'm sure it's the same thing with the stablecoins. It has in it the ability to know. And this is why when you go to the bank, they always say to you, what are you going to do with that money?
Yep.
And it pisses people off. But I guarantee you that they've been pushing this softly into the banks for a long time. They're trying to close the loophole around all of this. So while it is maybe the only way to get out of this problem without defaulting or hyperinflating, and that is to use the stablecoins to push down interest rates on the front end of the curve to give synthetic demand while they allow gold to come back, revalue it, and peg it to the back end to keep rates at zero, to bring back manufacturing. I mean, I see it happening. And if that's the case, you're going to see this just everywhere very quickly in an effort to keep demand going for a country that is maybe 25% of its way to its obligations just by 2028. And those are the bonds that are in circulation, let alone everything else. So, yeah, I think it's going to be fast and furious, Jared. I really do.